few years ago, selling your home within 1 year of buying it wasn't that big of a deal. There were no taxes to pay on a principal residence that you solely inhabited. Well, times have changed. Now, selling a primary residence in Canada can involve being taxed, which can affect your pocketbook significantly. Hi, I'm Julia, and I'm a real estate agent and enthusiast in Ontario, Canada. The purpose of this video is to share information in a more digestible way. In no way does it constitute advice. If you're looking for specific information about the tax implications of any property sale, speak with a chartered professional accountant in your area. So let's discuss why principal residence tax rules came to be, how this tax can affect your pocketbook, and exemptions to the tax that are important for you to know to save you money. Lastly, we'll wrap all of this up with what it means for you as a homeowner. It's going to be great. You might be wondering why the need for principal residence tax. Maybe you've seen one of the many TV shows where people buy a house in dilapidated condition, spruce it up, and sell it for a hopefully wicked profit, and repeat. This is called property flipping. Does the word maybe lucrative also come to mind? When done right, it sure can be. For many years, people were purchasing properties, calling them their principal residence, and then flipping them. They weren't paying business income taxes on these gains, but their profits were huge if they did it right. After all, the housing market was trending upward, so it was pretty likely that they were going to make money. Was it savvy? Sure. Was it fair? That part's debatable. If you ask me, while there are many other factors involved, property flipping has played a role in driving housing prices up in Canada. I work with a lot of first-time home buyers specifically hoping to buy an outdated property in a good location. Sometimes it's design preference, but more often than not, it's because these properties are more affordable than their renovated counterparts. The plan is that once the home buyers have gotten over their initial interest-heavy years of their mortgage, they would then renovate the home into something that's more suited to them. Property flippers can throw a wrench in this plan because they tend to pay in cash. And as we all know, cash is king. Many first-time homebuyers requiring a mortgage just can't compete. And forget about them buying a flipped property after renovations are finished. The prices then are unattainable. This is why, as of January 1st, 2023, the Government of Canada implemented tax rules surrounding selling a property within a year of buying it. Why? Essentially, if you're profiting like a business, you ought to be taxed like a business. So let's talk about how principal residence tax affects your pocketbook. Under the new regulations that came into effect in 2023, if you sell a property that you owned for less than 365 consecutive days, the profit you make from the sale won't be considered a capital gain. Instead, it will be classified as business income. Unless you're exempt, but I'll get to that in a little bit. And why is this significant? Because business income is subject to a different tax treatment than capital gains. Business income is taxed at a higher rate, more specifically, a 100% inclusion rate compared to the 50% inclusion rate taxed on capital gains. Additionally, you're required to report business income differently on your tax return, which can kind of be a headache. Of course, all homeowners want their property value to increase over time. But if you specifically buy a property with the intention of selling it for a profit, you'll owe tax on any gains that you realize from the sale of that property. Different types of investment properties are taxed in different ways. Whether you're into assignments, flips, building on vacant land to sell later, or buying a property for rental income, make sure to consult a tax professional so you can be sure you understand the tax implications ahead of the investment. To prepare for your meeting with your accountant, I highly recommend reading this Government of Canada article that goes into more detail about how various properties are taxed. You can find the link to the article below. Just to reiterate, property flipping involves buying a property with the intention of selling it within a short period, ideally for a profit. If you buy and sell a property in less than 365 days with the intention of profiting from it, this could be classified as business activity. And remember, business activity, in this case, any profit from the sale would be taxed as business income, not a capital gain. What if you own a duplex property and you live in one unit, or you have other rental suites within your property that you live in? If part of your principal residence was a rental property that you used for extra income, it may be that only part of your home qualifies for the tax exemption. In this case, you would be charged business income tax on the portion of the home that was generating you money. To determine the amount that would be taxed, you would use a calculation splitting the selling price and adjusted cost base between the portion of the property used for income and the part used as your principal residence. All right, let's talk about the exemptions to the principal residence tax. If you fall into the category of life upheaval, this part is the good news. Your tax treatment may be different if the property was already considered inventory or if you needed to sell the property because of or in anticipation of a life event. So I'm going to give you a list here, and now I'll warn you, it's a fairly robust list of exemptions, but maybe one of them applies to you. So first is death of the taxpayer or a related person. A related person joining the taxpayer's household, or the taxpayer moving in with a related person, such as a spouse, common law partner, or even for reasons like the birth or adoption of a child or caring for an elderly parent. The breakdown of a marriage or common law partnership where the taxpayer had been living separate and apart from their spouse for at least 90 days before the sale. We're seeing this one a lot. A threat to personal safety, such as domestic violence. Serious illness or disability of the taxpayer or a related person. Another common one here is relocation for work or school purposes, where the new home is at least 40 kilometers closer to the new work or school location. An involuntary termination of employment for the taxpayer or their common law spouse or partner. Insolvency of the taxpayer. And finally, destruction or expropriation of the property. So in these cases, even if the property was sold within the 365 days, the transaction could still be eligible for more favorable tax treatment, like I mentioned. But regardless of the tax treatment that awaits, you have to report the sale to the Canadian Revenue Agency or the CRA. As I've mentioned, always consult directly with a professional accountant. Specifically, it's wise to ask your accountant whether you would be exempt given your situation and what kind of paper trail you may need to ensure that there are no hiccups in the process later, because you don't want to be running around filing paperwork right around tax time when you have better things to do. So where does this leave you as the homeowner who's been thrown a curveball? Well, to wrap up, if you're selling your primary residence within a year of having bought it, the principal residence exemption typically protects you from paying taxes on any gain from the sale, as long as it was your principal residence for the entire time that you owned it. If you bought the property as an investment, be aware that the newer tax rules could apply. If you sell a property you've owned for less than a year and you don't meet the exemption criteria, the gain may be taxed as business income, not as a capital gain. So make sure to stay informed and consult a tax professional to determine how these rules apply to your specific situation. I know I've said that a million times, but it's important. That's why I've said it a million times. So understanding these rules can help you make the most of your property sale, avoid unexpected tax bills, and ensure that you're in compliance with Canadian tax laws, which is super important because there are fines for violating these rules and you don't want to have to deal with that. Lastly, I suggest reading another Government of Canada article titled Disposing of Your Principal Residence, which I'll also link below. I hope this was helpful and that you have a successful move and tax season ahead. I'm sorry life has thrown you a curveball. I hope you learn and grow from it. But yeah, everyone loves tax season, right? It's like the beginning of the spring housing market. So why wouldn't it be great? All right, I'll see you in the next one. Cheers.